Hello everyone, I'm Stephen Fox. Welcome to my channel. Don't you hate this when good news is bad news for the stock market? The numbers came out higher than expected. There were more jobs filled than what was expected. 170,000 jobs were expected, and it came in at 216,000. Now, immediately, and in the pre-market, the stock market went down massively. Because this is supposed to be really bad news because it means the Fed is going to delay the rate cuts. They've priced in 6 rate cuts. The stock market has. The Fed has only figured in 3 rate cuts. But the stock market wants 6 rate cuts. Are they expecting something to break? Because that's the only way that's happening. And after this number, you would think that it wasn't going to happen. But I think there's some doubt in Wall Street's mind whether to even believe this number. Because what they did is they revised the previous month's jobs down by 70,000. So this number, higher than expected, okay, suppose it's revised down 50,000. That puts it below what was expected. And that's likely to happen. And how are they doing this? Are they just juicing the numbers to make the administration look good? It begins to make a person wonder. I don't know that for a fact. Who does know? It's awfully suspicious that these numbers come out bold and proud and then they collapse to unbelievable depths that really would make a material effect if they were released correctly. Some things that seem probably less debatable is the average hourly wage increase. It increased by 4.1%, which was above the 3.9% that was expected. So that's inflationary. Okay, so the big number, 216, is inflationary. The average hourly increase is inflationary. This is looking really bad. And then to top it off, they were hoping for a slight increase in unemployment. That they wanted to increase from 3.7% the previous time to 3.8%. But it came in at 3.7%. So there's been no increase in unemployment, which is wonderful news for the idea that we're going to have a recession. A recession, according to these numbers, is nowhere in sight. So the Fed isn't going to cut rates. There's very little chance that he's going to raise rates at the January 31st meeting. And in March, it's unlikely that he's going to decrease the interest rate. Although Wall Street is expecting it to happen in March. At least some are expecting it in March. If you're thinking of 6 rate cuts, you would think it would have to happen in March. The oil price is staying in the 70s. There's been attacks by the Houthi rebels in the Suez Canal, which has screwed up transport of oil. And the Panama Canal is going dry. They use a reservoir to get the ships in and out, and that doesn't come from the ocean. It comes from a lake nearby or a reservoir nearby. That uses a lot of water on these huge ships. So they have a very limited number of ships they're letting go through. So, it's a long way around the tip of South America. I think Biden has done what he can to increase oil supplies, and we are the biggest natural gas provider in the world right now. Right now, the United States is the Saudi Arabia of liquefied natural gas. We have these things like travel. People are traveling more than they've ever traveled before. How does that happen in a recessionary like environment? So I think the risk is more to the upside on inflation, or at least it's holding steady and not going down, which means he's not going to change the interest rate. The CPI comes out on January 11th. And so that's going to be very influential to the future progress, although nothing's expected to happen at the January Fed meeting. I think, as one person put it on CNBC, we're just going to have longer for longer as far as the interest rates go, that they're going to hold them at this level for a long time. So I think we can get used to 5% interest, and I'm getting very used to it. I'm staying out of the stock market now. The only thing that looks hopeful is artificial intelligence stocks. That is, maybe it's a good thing, but it's hanging in there. I see artificial intelligence as the only thing right now that has the power to go against these higher interest rates. But I'm staying out of the stock market now until things settle down with this crazy election, the crazy wars we have going on. The Mideast, that is less likely to affect things, and I hate to say this because it doesn't involve an oil country, except the Hutu rebels. I think they're attacking partly in response to what's happening in Israel and in the Gaza Strip. So it's being affected that way. But there's not a direct war with an oil-bearing country. It's sort of an internal Israeli-Gaza Strip thing. But it's sort of a horror show in slow motion, and it just kind of continues on at a reduced level. I don't think that's nearly as concerning as the Ukraine war. The Ukraine war is really of concern, and it looks like Russia's doing much better than they were doing. They are training Ukrainian pilots on F-16s now. Everything is kind of at a standstill, but I think things are going to rev up this summer. This summer should be really wild. With the campaigning going on for the elections, and then the Ukrainian war is going to spike up with Ukraine getting F-16 jets. They can't really use the Challenger tanks that were given to them by England, and they can't really use Abrams tanks that they were given by the United States unless they have air superiority, and they won't have air superiority until they have the F-16s. So they sort of got to have the F-16s to make the wonderful tanks work. And Ukraine's main problem is a lack of men, okay? Their population is way smaller than Russia, and Russia has access with all these other countries that are willing to throw men into the fray. They've lost hundreds of thousands of men. Russia is making grinding progress forward, and that's sort of their history. If you look at what happened in World War II, if you try to outgrind the Russians, you're going to have a very difficult time doing it. The French couldn't do it. The Germans couldn't do it. Ukraine is kind of a different thing with them. It almost was, Russia considered it to be a part of them. They feel like they're fighting for their homeland in many ways because Ukraine was their breadbasket. And they feel like they've lost their breadbasket. It sort of would be like the United States losing part of the Midwest. The United States wouldn't be the United States without it. And so that's the situation with Russia. Russia really isn't an empire unless it wins Ukraine. And once it wins Ukraine, that is the worry, is that they would continue on. that they would try to invade Poland, although you would think that would be madness because NATO has vowed to defend those countries. Some of the only stocks to manage this carnage since the beginning of the New Year's rout is NVIDIA and Super Microcomputer. And this is not to say they did great. They did great by holding their own. And looking at the chart, you can see that they mostly held their own. NVIDIA lost 1.1%, and Super Microcomputer made 0.2% in 5 days. So it's remarkable that they held their own. But I think that's going to be the story going forward. I think in a good case scenario, we make modest progress with interest rates staying high. And that's if the economy stays strong. And it's hard to imagine how they're really going to get inflation down without slowing down the stock market more. So I'm out of the stock market. I got out during the week to avoid the carnage and to preserve what gains I had, and I came out positive. So I saved like 60% of the surge, and I was not going to lose all the surge. Just can't do it. That's the way this market has been. It's you get a surge and then you get the sell down, and it's happened again this time. This wasn't supposed to happen until the middle of January. I thought we at least would have the finish out of the Christmas rally, but that wasn't to be. Instead we got the New Year's rout. Happy New Year, right? I'm planning to stay out until things get positive. Things were even negative for bonds. The interest rate on bonds went all around 4%. It wasn't like 3.9s. And it was down there, and that's why you made a lot of money on bonds. And again, I wasn't going to lose the money I'd made on those bonds. So when it started creeping up, I just got out. And especially getting these numbers, that just put the whole kibosh on it. And on Friday, I'm glad I got out before Friday on the bonds, because on Friday it went above 4%. It was like at 4.04%. It's not usual for interest rates to jump around this much, guys. This is not a normal market. This is not a normal world. We are in bizarro world time. It's like a modified World War III. Can the wars stop coming? What is going on? I think we got a war in the external world, and we got a war going on with the deep division in this country, which has to stop. We've got to come around and have some more moderation and work together, because right now it's kind of us against the world in many ways, or us trying to help the world with the allies that we have. Hopefully we can bring ourselves together and bring the world together. I'm going to try to transition into presenting you with useful videos that are interesting. Frankly, I don't find this stock market very interesting. I find it more tragic than anything else. I think at best we'll make modest progress, and that's not my recipe for fun times in the stock market. So I'm going to try to present things that are of interest, probably mainly with technology, because that's where my heart and soul is. Thank you.